Welcome to the Explainer. All right, let's jump right in because we are currently witnessing a massive, completely unprecedented macroeconomic disruption. And wildly enough, it's not coming from Silicon Valley. It's coming straight from the pharmacy counter. Think about how the iPhone came along and literally almost overnight devastated the standalone digital camera market. We're seeing that exact same dynamic playing out right now, except this time a pharmacy drug is fundamentally dismantling the grocery store and the global food supply chain. The explosion of GLP-1 weight loss drugs, Ozempic, Wegovy, Zepbound, it's no longer just a medical breakthrough. We have to start looking at this as a financial black swan event. This is a secular shift that is quite literally rewriting the global economy and consumer behavior from the inside out. So today, we're not just looking at the pharma companies making these drugs. No, we are going deep into the collateral damage. We're diving into the short seller's new menu. Just consider this staggering perspective for a second. Ozempic isn't just a drug. It's a $1 trillion tax on the snack industry. That brilliantly captures our core thesis today. What we're actually looking at is a biological intervention that is actively destroying the total addressable market, the TAM, of entire industries that, let's be honest, have been built entirely on metabolic dysfunction. For decades, the foundational business models of big food and certain medical device sectors have relied on the continuous compounding of caloric overconsumption. So when human caloric intake structurally drops, those foundational models don't just bend, they fracture. If you want to really understand the gap here, the true alpha in the market right now, you just have to look at this jaw-dropping divergence. On one side, we have the innovator. Eli Lilly's revenue absolutely surging by 56% in the first quarter of 2026. And then, on the flip side, you see the legacy inputs of the food industry. We're talking about the global sugar index plummeting right alongside profits for legacy treat brands like Magnum ice cream. You see, the global sugar index is this highly sensitive leading indicator for global snack consumption. So when that index collapses, it tells us commodities brokers are pricing in a systemic, long-term reduction in future demand for sweets. The market is finally waking up to the fact that money is draining rapidly out of one ecosystem and flooding directly into another. So here is our agenda to map out this blast radius. Section 1, the weapon. Section 2, biology rewrites the economy. 3, the Lilly's death zone. 4, the PepsiCo value trap. 5, big food's retaliation. And finally, 6, the protein infrastructure. Let's start with Section 1, the weapon. Just look at the divergence in this data. By the end of 2025, Eli Lilly's stock price hit an all-time high of over $1,100, with year-over-year revenue growth accelerating to 44% and then hitting that 56% mark by Q1 of 2026. But look over at the sugar futures sentiment. As Lilly soared, New York raw sugar futures just completely broke down, actually falling below 14 cents a pound to multi-year lows. Now, to understand why that matters, you've got to realize that 14 cents a pound isn't just a dip. That is a panic-level crisis for commodities brokers. It essentially establishes a fierce bear case against the foundational ingredients of ultra-processed foods. GLP-1 prescription volume has literally become a direct leading indicator for the decline of junk food commodities. The more prescriptions written, the less pricing power sugar has globally. It's really that simple. Moving right along to Section 2. Biology rewrites the economy.
Okay, so the absolutely crucial point here is understanding how these drugs actually work in the wild. It's basically a three-step behavioral disruption. Step 1. The drugs mimic the GLP-1 hormone naturally released in your gut, but the synthetic version lasts much, much longer. Step 2. This delays gastric emptying, meaning the stomach physically retains food longer, which obviously prolongs the sensation of being full. But step 3, guys, step 3 is the holy grail for short sellers. It silences the dopaminergic reward pathway in the brain. Imagine your brain has a thermostat for food cravings, and for your entire life, it's been permanently jammed at a frantic 80 degrees. GLP-1s basically hack the wiring and drop it to a calm, cool 68. That constant food noise, the impulse that makes you desperately crave hyperpalatable, sugary, salty snacks, it's just turned off completely.
And when you silence that food noise, grocery baskets get systemically reconfigured. Check out these shifts. Overall energy intake, sugar, saturated fat, they're all down. But pay attention to that bottom row. Protein intake is up by 4.2%. This tells us consumers are making a highly specific, calculated pivot away from calorie-dense, low-value processed goods and moving directly into nutrient-dense proteins. They're buying less overall volume, sure, but the actual composition of what they are buying has completely inverted.
To really put a magnifying glass on this phenomenon, let's examine this granular analysis from Cornell University tracking 150,000 households. Within 6 months of a household starting a GLP-1, their overall grocery spend drops by 5.3%. But that drop is not distributed equally. Savory snacks drop 10%. And then, look at that final data point. Desserts and sweets suffer an astonishing, utterly devastating 84% decline in spending. 84%. Think about what that actually means for a physical retail grocery layout. Grocery stores rely heavily on end cap displays. Those highly prominent promotional shelves right at the end of the aisles that are designed entirely for impulse sweet purchases. When 84% of that specific spending just evaporates, the profitability of that prime real estate is destroyed. This isn't just some new fad diet we're talking about. This is a massive structural headwind for the entire junk food industry.
Section 3. The Lilly Death Zone.
So the very first casualty in this death zone is obviously the ultra-processed food sector. And to grasp exactly why it's so bad, you have to understand the concept of the super user. In the junk food industry, the Pareto principle applies heavily. The top 20% of consumers actually account for up to 65% of total sales. These are your high-frequency impulse buyers. A super user isn't someone who occasionally buys a single soda on a Friday. It's someone purchasing and consuming 3 sodas every single day. So when these super users start taking an appetite suppressant, the food industry doesn't just lose a little bit of marginal volume. Losing one super user is the mathematical equivalent of losing 10 casual users. They experience a brutal, completely non-linear collapse in demand. As a prime case study of what happens when you lose that super user demographic, let's look at Magnum ice cream. I think it's incredibly telling that Unilever specifically spun off their entire ice cream division right before this data hit the mainstream. That is a textbook example of smart money fleeing a doomed sector before the bottom falls out. Because immediately after that, Magnum faced what analysts dubbed a sweetness crisis. Net earnings dropped by nearly 50%, and their organic sales growth slowed to a crawling 0.7%, which drastically missed forecasts. The market suddenly realized that treat buying behavior had permanently shifted. The super user isn't even stopping. They are walking right past the freezer aisle. Pivoting over to the second sector, trapped in the death zone, we have to introduce the concept of TAM erosion. That's the slow motion contraction of a total addressable market. Now, unlike the food industry, which sees these immediate drops right at the grocery store register, medical TAM erosion takes about 3 to 5 years to fully reflect in earnings reports, and that makes it a hidden and incredibly dangerous threat to investors. This brings us directly to kidney care and dialysis providers like DaVita. Historically, these businesses relied on the steady, uninterrupted progression of diabetes and hypertension to continually fill their clinics with brand new dialysis patients year after year. Check out this data from the recent FLOW trial. It turns out GLP-1s provide profound protective benefits for kidney health. They significantly delay the progression to end-stage kidney disease. Hospitalization rates drop by 9%, and mortality drops by 17%. Now, clinically speaking, this is an absolute miracle for patients. It's easily one of the greatest medical advancements of our time. But there is a very bitter irony here. Financially, for a stock that requires a predictable, growing pipeline of sick patients to maintain its high valuation, it is absolutely devastating. The very patient pipeline they modeled their entire future cash flow on is fundamentally shrinking. The third pillar in the death zone is the respiratory medical device sector. We're talking specifically about companies like ResMed that manufacture CPAP machines for sleep apnea. Sleep apnea is, of course, highly correlated with high body mass index. Now, ResMed defends its stock by pushing what the bears are calling the adherence myth. They claim that current patients on GLP-1s actually use their CPAP machines more often. And hey, that might actually be true for today's existing patients. But the reality check is that stock valuations are based purely on future growth, not current maintenance. If the broader population is sustaining a 15 to 20% body weight loss across the board, the massive influx of future sleep apnea patients that these companies modeled their long-term growth on, it simply will not materialize. Section 4. The PepsiCo Value Trap. Right now, PepsiCo is trading at around 19 times forward free cash flow. For a legacy consumer staple, a retail investor looks at that multiple and says, wow, that's cheap compared to its historical average of 25. I should absolutely buy the dip. But here is the brutal truth of why that is such a dangerous value trap. Applying historical valuation metrics assumes that the future is going to look exactly like the past. Imagine buying Blockbuster stock back in 2008 just because the price-to-earnings ratio looked incredibly cheap while completely ignoring the fundamental shift to digital streaming. Fundamental calorie consumption is experiencing that exact same kind of secular contraction. If the Frito-Lay division is facing a permanent drop in snack volume, that quote-unquote cheap 19 times multiple is actually an illusion. It's based entirely on outdated pre-GLP-1 growth assumptions.
Section 5. Big Food's Retaliation.
Now, let's look at the defensive tactics popping up across the board, because Big Food is not going down without a fight. Nestle launched Vital Pursuit, which explicitly targets GLP-1 users with portion-controlled, high-protein micromeals. General Mills is desperately shifting 10% of all their R&D into protein-enhanced snacks. PepsiCo is out there buying clean, prebiotic brands like Poppy to try and clean up its image. But the most revealing tactic by far is that last one. Food scientists are now attempting to microencapsulate bitter compounds into junk food. Let that sink in. They are literally trying to artificially trigger the natural GLP-1 release in your gut by sneaking bitter agonist past your taste buds. I mean, that shows you exactly how panicked they are. They're trying to literally hack human biology just to keep people snacking. But the big takeaway here is this. Transitioning from high-volume cheap potato chips to low-volume, highly engineered functional foods is incredibly capital-intensive and margin-dilutive. It essentially costs them significantly more money to make less money.
And finally, Section 6. The Protein Infrastructure.
To find the actual winners in this new environment, you have to understand sarcopenia. When you lose weight rapidly on a GLP-1, you don't just lose fat, you lose a highly disproportionate amount of lean muscle mass. This can lead to severe frailty and some serious long-term health complications. So, to prevent this, doctors issue a strict protein mandate. Users are essentially required to consume 1.2 to 1.6 grams of protein per kilogram of body weight every single day. This proves that the massive shift toward protein isn't just some fleeting fad diet. It's a strict medical necessity. It enforces a mathematical reality. If you are eating 40% fewer calories overall, the density of protein in the food you do eat must skyrocket to compensate. Which brings us to the ultimate divide. You've got the hype versus the plumbing. The hype is the frantic energy of legacy consumer packaged goods companies. They are spending millions on R&D, desperately fighting each other over a rapidly shrinking pool of impulse buyers. But then, on the flip side, you have the plumbing, the unglamorous, steady, and highly profitable industrial processors. We're talking about the companies quietly managing bulk meat, advanced rendering capabilities, and highly technical whey handling systems. They don't care about flashy branding. They aren't fighting for supermarket shelf space. They operate entirely in the background, simply supplying the biological mandate that the entire market now requires. Let's look at some of the highly actionable beneficiaries here. Tyson Foods is already expanding its ready-to-eat lean chicken lines by 12% to meet this exact surge in demand. And let's talk about industrial rendering. These massive facilities take the waste products from meat processing, the parts humans don't eat, and systematically convert them into high-margin products like aquaculture feed or premium pet food. This creates an invincible margin advantage that traditional snack companies simply cannot replicate. Meanwhile, you have companies like PMG Engineering designing the complex, highly technical plants needed to extract pure whey protein from dairy at industrial scale. With an estimated 30 million Americans projected to be on these drugs by 2030, this infrastructure is a guaranteed volume play. They are perfectly positioned to capture the massive GLP-1 premium while Big Food scrambles. So, as we wrap up this explainer, I really want to leave you with a provocative thought to apply to your own portfolio. The next time you see a legacy junk food or dialysis stock dropping, and it looks cheap on paper, you need to ask yourself, are you buying the dip or are you buying the trap? The global economy is literally being biologically rewritten right in front of us. Protein is no longer just a macronutrient. It's the fundamental currency of metabolic survival. Make sure you're investing in the plumbing of the future and not the hype of the past.